Good afternoon, everyone. Welcome to today's webinar, which is our CCIM monthly webinar. We're really excited to have you here today and our speaker. My name is Kelly Richardson. I am with Rowley Properties. I'm the designated broker. I'm also the CCIM Washington State Chapter President for 2021. I'm honored today to have my cohort, Steve Clark, with North by Northwest Real Estate. He is also on the CCIM board. He is the membership chairman, so he will be moderating today's webinar. I want to thank our annual sponsors today. I want to thank the Benaroya Company, Lisa Goodman and Larry Benaroya. Space needs for office and industrial, so thank you so much for Lisa and Larry. IBA, Kurt Meyer. They do mergers and acquisitions, and you're going to hear me talk a little bit about that as we get a little bit farther along. Ameriprise, Kevin O'Keefe. He does asset management and grows your portfolio, so please see him for your stocks and bonds and portfolio needs. Rob Sargent with Sargent Legal. He is a longtime real estate attorney and can answer all of your questions with regards to real estates, investments, etc. Please see Rob for your needs. Stuart Title, Kelsey Azur. Thank you so much for being a sponsor, and please see Stuart Title for all your title needs as well. And they're actually going to be helping with the webinar next month with our economist. I also want to thank our annual sponsors. We have a new sponsor, Bank of America, Lee Wang. Thank you so much, Lee, for being a sponsor. McConkey Development, Fred McConkey. Rowley Properties, myself, Kelly Richardson. Dirtfish, Molly Schaefer. They're out in Snoqualmie, so they are a rally car racing school, the only one in the West Coast. Blue Ink, Chris, residential real estate brokerage, does residential and commercial in the North End in Bellingham. Great Earth Realty, Larry Yu. Larry is our 2022 board president, so happy to have him sponsoring as well. Our media partner sponsors, the Daily Journal of Commerce, and our in-kind sponsor, BDP Design, Kelly Beckley, for all things marketing. Thank you so much to all of our sponsors. We truly appreciate all of your support. I wanted to talk about a new program that we have now with CCIM, and you can find this on our website, CCIM-WA.com. This is our commercial real estate consultation clinic. This is a weekly series at no cost, and we have experts from asset types talking about what is new in their particular assets, also going over any Q&A. It's also a great time to network. So this goes from Wednesdays, every Wednesday from 4:30 to 5:30. You can see the dates and times here, and you can register on our website at CCIM-WA.com. All right. Amy, is there any, I've seen someone who's having some difficulty with some sound. Can we hear, can everyone hear okay? Okay, great. Thank you so much for the feedback. Okay, so this afternoon's asset class consultation clinic is actually mergers and acquisitions with Gregory Kobisky, and he's with IBA. So check that out, and that's at 4:30 from 4:30 to 5:30 this afternoon. And then on Tuesday, March 16th, there is a Real Estate Investment Insights webinar series, and this is going to be going over the Kent Valley and the North Pierce County area. And this is from 3 o'clock to 4 p.m. So this is at no cost as well. So please check this out. I mean, it's going to be a great webinar. Next month's program, we are thrilled to have Ted Jones, the chief economist with Stuart Title. And that's going to be April 14th from noon to 1. And please register in advance for this. Again, you can register on our website at CCIM-WA.com. He's going to be giving an economic update, and we're all interested in what's happening with the economy, I'm sure, at this time. All right, so the Institute is offering the CI 101 through 104 classes in an online condensed format. Please visit our chapter website for more information at CCIM-WA.com. And in addition, I wanted to go over some housekeeping for today. Now, if you're having any trouble with whether it's sound or what have you, you can try logging out and log back into Zoom again, and that can really help. Um, you can also upvote your questions, and then please use the Q&A forum to do that. And we are recording this webinar, and it's going to be available on demand on our website, CCIM-WA.com. At this point, I would like to introduce our moderator for today, and that is Steve Clark. He is our CCIM membership chairman. We're thrilled to have you, Steve. And Steve is with North by Northwest Real Estate. So, Steve, I'm going to have you take it away.
Thank you, Kelly. Hello, everyone. Thank you for joining us today. My name is Steve Clark with North by Northwest Real Estate. It is my pleasure to introduce our guest speaker today, Ryan Gibson. Ryan is the CIO and co-founder of Spartan Investment Group. Ryan will spend the first 30 minutes of the webinar discussing how his company has accelerated the growth of their self-storage portfolio using syndication to fund their projects. After the presentation, we will open up the webinar for questions from the audience. And with that, I've seen Ryan's presentation. He's got a lot of fantastic information to share with us. Ryan, as soon as you're ready, please tell us a little bit about yourself and take it away.
Thanks, Steve. Thanks, Kelly, for having me, and looking forward to presenting today. My name is Ryan Gibson, and I'm the co-founder and chief investment officer of Spartan Investment Group. And I'll go ahead and put up the slide here. My background is actually as an airline pilot. I was a pilot for Alaska Airlines for a few years, and recently a pilot with Delta. And had a background in aviation, moved to Seattle at the end of 2014, 2015, live in the Laurelhurst neighborhood. And I have a 1-year-old son and a 4-year-old daughter that loves to ride her bike and is a lot of fun. Getting into skiing now too. I started the business with my co-founder, Scott Lewis. And both of our wives actually joined the business early on, and the company has really grown since then with their help and with the great people that we've hired thereafter. So I'll get a little bit more into my bio as we get going, but Spartan Investment Group is the company that we started originally in Washington, D.C., but now we have offices in Westlake, Seattle, and we have our corporate headquarters office in Golden, Colorado. Last year, we were recognized by Inc. magazine as one of the top 500 fastest growing companies, privately held companies in the United States. And we operate self-storage facilities under our national brand, Free Up Storage. And so that's a picture of our team there last year after we got the Inc. 500 recognition. What was really neat was we actually made the 8th fastest private-owned real estate company growth in the United States last year. So we're number 8 on the real estate list, which was very fun to get in the magazine for that. And just a little bit about our company. We have about 7,500 units under management. That's both RV parks, self-storage, and if you're familiar with the manufactured housing community that's being built in Sequim right now in our Olympic Peninsula, we're building 217 lots of brand new manufactured housing development over 38 acres in sunny Sequim. We have about 35 employees at the moment, which is going to grow next week by about another 4. So very fast growing, 150 million of assets under management. We do syndicated private debt and private equity, and we have about 238 active investments placed right now across 238 investors. And we've raised about $50 million of private equity and debt to date. And 10 of our projects, we've done about 21 syndications, and 10 of our projects have gone full cycle, meaning that we raised capital, we bought the asset, and then the asset sold and closed out. This is just a kind of a snapshot of our team. And we're a vertically integrated company, meaning that not only do we do the syndication, but we act as the general contractor. So we have a construction division. We do the property and asset management in-house. So we hire all of our frontline employees. We do the acquisitions, asset management, and then we also do our own feasibility studies internally with our data scientist and research team. So how did it get started? everybody kind of wonders where everything kind of starts initially. And kind of a classic American small business story. If you look at the picture in the middle, that's a picture of our first flip that we did at Spartan. And the White House on the left was the first house I ever purchased. And the greenhouse that matches my business partner's military gear is my business partner's house. And we met on the street in Washington, D.C. As neighbors. And we decided to flip the first house that we could find, which happened to be the house that we both shared walls with. So we did our first flip. It was a very difficult property to get the right of ownership. The property was vacant for about 20 years, and there were squatters living in it and things like that. And what it was interesting, the LLC that bought the tax lien on the property had dissolved in the 90s, and we had to go through quiet title and do a quitclaim deed and really clean up the title to get it into a position where we could actually get the right path of ownership. And a lot of the title companies, said, wow, there's a lot of developers in DC, but none of which want to go through this process that you guys want to go through. And it really helped our seller out. And Scott and I were very aligned from the beginning, which was, we wanted to improve lives through real estate. So everybody that we did business with, every employee that we hired, every investor that we work with, every seller or buyer of a property, we want to somehow improve their lives. So we look for the angle, the win-win, and truly care about our partners. Scott and I both had really good jobs prior to this. I was an airline pilot. That's my daughter on board on Alaska 737. I can't remember where we were going, but it was one of her first flights. I get a picture of her every year in the flight deck, so I've got some future ones as well. And Scott was in the military and was working at the VA, a GS-15, did really well. So we didn't really need to, we had a pretty good life, but we wanted to build something and really provide value to a lot of people and kind of put a company together that covered all the things that we didn't like about our current employers or maybe past employment. So this is our mission, vision, values. We're not really getting into capital raising with this, but I think it's really important that every company has a mission, vision, values. We put ours up on the wall in our offices. We go over them every week on our sync call. And we really our values are defined by our grit. And I think that's kind of a neat thing that we have, which is growth, respect, integrity, tenacity, and transparency. And we actually have it trademarked, invest in our values. So when you're thinking about raising capital or, raising money from private investors or whatever it might be, give them a reason more than just a return to invest with you. Maybe you're what's your why? I really want to encourage people to think about what their why is, especially if you're thinking about raising capital outside of your own organization. It's a completely different ballgame. You're taking other people's money. It's not just yours. So if you drop the ball, it's not just your own mistake. It's now somebody else's livelihood that you have. So, we really put a lot of horsepower behind our communication, our transparency, sharing information with investors, and making sure that they feel like they're part of the team and know what's going on with the investment. The other thing I encourage people to do if you're going to raise capital is develop a strategic plan. And anybody can go on our website, spartan-investors.com, and download our strategic plan. You don't have to put in an email, at least I don't think. And what we do is we have every 3 years we refresh our strategic plan. And our strategic plan basically says to build a $250 million portfolio. Goal number 1. Goal number 2 is to raise capital to do that. And number 3, to be efficient, have a shared consciousness across the organization. We do everything from property management to construction to capital raising to acquisitions. So there's a lot of things going on, and we really want to have an emphasis on having that shared consciousness so that the company continue to grow and employees can feel connected to what we're all about. So this is kind of a fun slide here. This is the type of deals we do. So the bottom right there, that's actually in Black Diamond, Washington. We're building a 110,000 square foot facility, about 755 units. And you can see the time lapse there. That's from about, I think I put that together maybe a month or two ago. But we're just about to open the first couple of buildings. Will be open in May. We'll have a TCO on the building that you kind of see front and center there. So we look for raw land development. So if you have a raw land and you're looking to sell something or you're brokering something, we're definitely always looking for raw land development. And that was a tricky development. We actually had wetlands and conditional use permitting and things like that. The top right is the deal that we're going to talk about today. We're going to do a live case study. That's 11 buildings, and the little orange box is expansion. So is an existing self-storage that we buy and we add on to them. So those are kind of the two main focuses in our company. We look at about 150 target markets across the United States. This website, or this map, is on our website. We looked at, self-storage. There's only about 60,000 facilities in the United States, 30,000 of which don't really meet our criteria. So we really have to go far and wide. If you're in multifamily, you can probably get enough deal flow in one market, but for storage, there's just not very many of them. So we look at age, population, saturation, job growth, net migration, all the characteristics that make a good project and what our criteria is. We've narrowed it down to these 150 MSAs. So these are our focus areas. So you can see we're very focused on the Pacific Northwest. We look in places like Texas. We have a very big presence, 11 facilities in Texas, Arkansas, Florida, kind of throughout the southeastern part of the United States. We stay away from California. We stay away from New England, and most places in the Midwest, just because of some of the negative growth rates. Population growth is really what drives storage business. So this is our acquisition team, which actually has grown recently. We have 2 more acquisitions folks joining our team starting on Monday. Last year, we looked at about 1,200 deals. We issued 24 offers. We closed 9 new projects in 2020. And we have a goal this year to acquire 150 million in new projects. So we're very aggressively looking for new projects, and we are trying to buy 2 self-storage facilities every month in 2021. So a lot of deal flow this year. So this is a case study, and instead of talking about raising capital, we are going to talk about the technicalities of it. But I'm just going to show a live deal that we raised money for, and go into how we raised money for it, where the money kind of came from, and how it was completely structured. So this is a facility located about 45 minutes south of Dallas, Texas. This is in Corsicana. We bought this in 2019, about 2 years ago, almost to the day. And we bought it at a 7.38% cap rate, $440,000 a year in place NOI, and the facility traded at about $6 million. So if you look at the bottom pictures, it came with a car wash. It came with the middle picture, the land to expand, and it also came with a U-Haul truck rentals business. And then it had the existing buildings in place. So this is the video. I'm kind of just we'll fly around here with my drone and kind of look at the project. It's in Corsicana. We had some exterior units and interior units. It was a pretty nice facility, about 735 units total, about 81,000 square feet. It has the indoor units with the climate controlled air conditioning units. Total 9 acres. And then, like I said, it had the 2 acres that we could expand the existing business on, and which we've done. We actually just got our certificate of occupancy today. Had the car wash on it, and we'll talk about that. We actually just sold the car wash. That was part of our strategy to separately parcel it and get rid of it, because we're not car wash people, and we don't really focus on that asset class. So we really wanted to get rid of the car wash portion to make the self-storage business more attractive to an eventual buyer. So how did we stack the capital for this? So if you look to the left-hand side of the screen, we raised private equity, $2.3 million, and we got private debt from a local bank for 5.2. So we in total had a total capital stack of $7.5 million. Where that went was $6 million to purchase, $1 million to build it, $250 million in project fees, and then we put $250,000 into our operating reserve. So we're going to drill into the project fees here in a second, but that's basically kind of how we structure these deals. We say how much capital, how much, where are we getting the sources and uses. What's really fun is what we're doing now. The debt we're actually raising with private investors. So we offer a debt product, a personal guarantee, deed of trust against the property. And we offer debt as well, but we eventually refinance out with a conventional lender, usually a local bank. So let's talk about fees. If you're looking into getting into syndication, a lot of questions I talked to Steve about, before this is, we want to see how these fees come out and how an operator can make money, or our sponsor can make money by raising capital and doing projects. So the first fees that you have are probably the most basic, which are kind of your acquisition fee and your asset management fee. So I know you notice on the slide, I had 250,000 in fees. So, in a $7.5 million total project cost, that's all the purchase, land, construction, everything that's going into the business. We have a 3% acquisition fee that we charge the project so that we can run and build our company. That's how we built our company, is on fees. And so that's $225,000 that goes to Spartan on the day that the deal closes. So the other way we make fees is through sponsor fees. The reason why we're able to do our own in-house property and asset management is we charge sponsorship fees. Now, these fees are only paid to Spartan if we act in that capacity. So if we go hire CubeSmart or Extra Space or a property management company to run that facility, we wouldn't get these fees. So if you notice the disposition fee, so if you're a broker listening to this and you sell the property and you're also the syndicator or operator, we reserve the right to take those fees if we don't use the services of a broker to sell the property. So as an example, this facility produces about 1.2 million in annual gross revenue. I don't know what it is exactly off the top of my head, but if we charge a 5% property management fee, we're looking at about $60,000 coming off that asset every year that gets paid to Spartan for being the property manager in that deal. That's just one example. So when we looked at the deal, what makes it a good project? We do a competitor analysis. So we look at all the competitors in the market. We look at their occupancy level. We look at their pricing. We mystery shop. We do a desktop study. We have our team that does the research in the feasibility in the market to make sure that it's a good, good demand facility. And we look at the rent roll, right? So we look at, that's some of the due diligence that we do here. We're not going to go through all these numbers, but I just wanted to throw them all up on the screen so that you can see, we've got 5x10s exterior, and then we have 5x10s climate. And then down below, you see we have the 10x10s. We also have 10x15s, 10x20s, et cetera. We noticed that, the storage operator that was currently running the properties, a mom and pop, they really weren't pushing the rents to what the market could be. So we noticed a gap between the current rent and the street rates. And so we noticed that when we added it all up, we said there was about $165,000 a year gap between current and street rates. So if you look over to the right-hand side of the screen, you can see our 5x10 unit mix on the rent roll. And you can see that, at the bottom, there's 67 units being charged $47 a month. But if you look at the top, there's units that are only paying $23, $24, $26 a month. And we can calculate what that gap is. So, for example, 19 units, 5x10s paying less than $35 a month. So the standard rent was $47. So we went through unit by unit, did our due diligence, and figured out that there was a gap between current rent and street rates of $165,000 a year. So then when we put the deal together, we underwrote increasing rents conservatively, $72,000 a year over 18 months. That way, when we project this to our investors, it's not overblown or perfect, or all the rents happen on the first day. We kind of build our pro forma to happen over time and to a conservative amount. So we have about $6,000 of cash flow is what that adds. And if you divide that into our target disposition, 6.6 cap rate of 1.2 million or 1.02 million in total value. So the next thing that we did in due diligence here is we look at, we engage a civil engineer to maximize the site plan, because you've got this full 2 acres. So you've got to have the civil engineer go through and say, okay, how much can we actually build here? So, when you look at the plat down below here on the screen to the right, there's a gas easement that goes through the property, so we can't build on that. And then the civil engineer determined that we had a stormwater pond requirement for stormwater control, so we couldn't build over there. So he figured that we had about 40,000 square feet possible. We did a market study. The market study, I think, was right about 40,000 square feet of unmet demand. But we wanted to be conservative. We're like, let's just try to build 20,000 square feet. And that's what we underwrote to our investors. That way we can underpromise, overdeliver. And when you're raising capital, it's probably one of the most important things you can do is not overinflate your projections to your investors. There's operators that get in trouble for that. And it's also the right thing to do from a perception and communication standpoint. So here's what we did. We underwrote 20,000. For this property is about $1 million build budget. We gave ourselves 6 months in the pro forma to build the facility, and then we gave ourselves another 15 months to lease it up. And that produces about $155,000 a year of additional NOI, which would value the property at another $2.34 million in value add. And then some of the other things that we do to the property, kind of basic stuff. We rebranded to free up storage. We increased the rents to market rate. We train the staff better for customer service. We develop partnerships in the community, add tenant retail sales, really get that ancillary revenue up, U-Haul sales, vending, merchant, things like that. So this is the property now. You'll see to the left there, the date on that C of O, I think is like today or yesterday. Yeah, there it is, March 8th, 2021 in the bottom right there. But there it is. There is our camera live stream or time lapsing the expansion of that 40,000 square foot building. So you can see we've got it C of O now, and our lease up starts today on the additional expansion. So that's part of our business plan that we projected to our investors. All right, it's almost done there. Perfect. So another thing we do is we do cost segregation study. You could do an hour. We could probably do an hour-long conversation about cost segregation, bonus depreciation, but we do a cost segregation study here. In this instance, we had about $1.7 million in accelerated depreciation that we took in the first year. So that passed through to our investors. So usually there's enough bonus depreciation to take a loss in the first year, and likely there's enough to take a loss or to not pay any gains on distributions for the first 5 years, which is typically why we do 5-year holds, because our investors have the most tax advantage through that 5 years. A little bit about tax losses. There's the live K1. So if you notice, this investor we've de-identified, but they invested $50,000, and in the first year they got a $21,000, maybe $22,000 loss on their taxes. I think the property distributes about 12% per annum cash on cash paid monthly. So most of their distributions are being shielded by costs or by losses that were taken for bonus depreciation. So usually losses in year one. And what's interesting is you're thinking about being your own operator is you can share in those losses. If you write the PPM that we'll talk about in a bit to prorate the losses that go to the partnership, and you have at-risk capital or a capital account balance, you can take those losses against your business. So when we have the 1.7, we share that with our investors in losses. So usually we're not paying a lot of taxes, but we get a significant reduction by having a bonus depreciation cost segregation done. We issue our K1s in March. If you're an operator thinking about getting into this business, I would have your act together with your CPA to make sure that you can actually get your tax returns done by March or by the end of March, so that your investors aren't nagging you in March and saying, hey, what do I need from you to get my tax return done? It's just a nice customer service thing that we do. So assumptions, they're just assumptions, kind of a little bit of a joke there with the donkey here. But we usually assume about a 40% expense to income gross ratio for our underwriting. And these are just generalizations. They can vary widely among property type. Max economic occupancy usually goes to about 90%. We assumed a 20,000 square foot expansion here, 6.6% cap rate exit. Obviously, for those on the call that are in storage now, that is a much lower cap rate for an asset class of this size, stabilized. It's probably down into the mid fives, maybe low 5 cap rate for a quality facility like Mini West. And then we targeted a 5-year hold. That's how we bookended all of our projections to our investors. For financing, we got a 75% loan leverage with a local bank, Community National Bank of Texas. We got 4.5% interest rate. We got 2 years of interest only, which is excellent because that really increased our cash flow in the beginning as we raised rents and improved operations. And then after 22 years, it goes to a 25-year fully amortizing loan. And what was really neat was we didn't pay for the draw for the construction, and we could draw on the construction funding whenever we broke ground for up to 3 years. So if you notice, earlier I had a 1.0 construction budget. That was for 20,000 square feet, but we ended up actually going to 40,000 square feet. So what was neat about the local lender was we just had a conversation with our lender and said, it makes more sense to build 40,000 square feet. So can we increase proceeds to do it? And we ended up building 40,000 square feet for about 1.6 million. So what happened to the deal? So we're about month 23 of our 60-month hold period. We proposed that we raise rents $72,000 a year over 18 months. This is where we're actually at today. We've increased rents to $133,000 a year. So that's very good. We also proposed to our investors building an additional building that would produce an extra $155,000 a year of NOI with a 20,000 square foot expansion. But we're completely done in C of O now to build for the 40,000 square feet. So our increases in NOI will be around 300,000 a year. And then we had the existing NOI when we bought the facility. So before, we projected the facility's value to be about 10.15 million when we sold at a 6.6 cap rate. And now we're looking at a new projection of about 13.271 million. And I would imagine that cap rate of 6.6 is a bit more compressed. So the facility is doing very well, and we're projected to close this asset out ahead of expectations. Some food for thought: if you're going to raise capital, what is your plan to communicate financials to your investors? So this is a real snapshot of Mini West. We show our investors distribution, revenue, expenses, and net ordinary income analysis, and we show them what it should have been, and we show them what it actually is. So if you look at the distribution analysis up there, you can see the last quarter we're doing, around 10 to 12% per annum. We were supposed to be a lot lower as we drew the construction budget down and debt increased. We were supposed to start having heavier expense load. So, but the revenue is up 38% in rental increases. So we're actually able to completely outperform where we are now, because our revenue is up and our expenses are down. We actually got a little bit of a lower interest rate than anticipated. So just food for thought. Investors like this, they can look at it and they can kind of know what's going on with the property, good, bad, or indifferent, in about 10 seconds. So it's just a great way to report versus just throwing them a P&L and saying, yeah, here's a P&L. You can tell what's going on, but you can't tell if it's going better or going worse based on where the asset is. So Steve and I talked yesterday, and he really liked this slide. It's who's on our network list? How do we find our investors, and who actually is on our list? Who do we send emails to? Kind of where did we meet them, and how does it break down? So we have about 2,700 investors on our distribution right now. We've been doing this since 2013. And this is where they come from. We categorize, every time an investor comes in, we categorize where they come from. So personal relationships are people like, you worked with them, your neighbors. Steve and I would be a personal relationship. We're kind of we met in the neighborhood, whatever. You kind of know each other from, something you do recreationally or whatever it might be. But you have a relationship. Meetups, that's CCIM all day. CCIM, maybe meetup.com, a conference that you go to. Online web takes are just kind of our online web form, or just people that come in through our website. We don't really know where they came from yet, but they came in through there. And referrals, webinars, so on and so forth. So the question I always like to give you is, before I flip to the next slide, who do you think actually invests? These are the people on the list, but who's actually pulling the trigger? And I want you to think about that for just a second. And this is actually who pulls the trigger. So when you're thinking about really forming high quality relationships with people, those are the people who trust you, and they know you, and they know your capability, right? And this is changing actually, because as our company is becoming more established and we're getting more referrals, our referral base of investors actually has grown quite a bit, and our meetup category has grown. And I haven't updated this slide in quite some time, but it's about 33% meetups, and it's about 33% referrals now. So it's pretty in balance. Not a lot of people finding us on the internet. It's impersonal. They don't know who you are. But a lot of people knowing us from the past, referring our business to other people, and then getting out there in the world and telling people what you do is a great way to, to increase your list. So I'm going to talk a little bit to wrap this up on, how to build a brand and build a business, because we really don't think of this as going out and doing deals. We think of this as growing a company. How can we grow a company that is capable of handling the deals that we buy, raising the capital, and performing well for our investors? And we really put an emphasis on our people that will eventually build our company. So The first thing that we did was we used syndication as a tool. So we're not a syndication company that does a fund to fund or raises for other people. We use it as a tool. And the best example I can give of this is, let's just say, close your eyes for a second and think, I have $1 million in my bank account and I find a deal that costs $1 million, right? And it will profit $1 million. So your cash on cash is 100%. It'll take a year. And you might think to yourself, why would I ever go out and syndicate when I have $1 million in the bank and I can just do this deal myself? Well, let's just say for a second, you decide to syndicate and you take that $1 million, and instead of investing that money in that deal, you go out and raise $1 million. And maybe you tell an investor, I'll give you 20% for a year's worth of time for your $1 million. And they say, wow, a 20% return in a year, that's pretty good. And I don't have to do any work, right? You still make 800,000 and that investor makes 200,000. You still have that $1 million in your bank account, which you can now go build a company with. You can hire acquisitions people, you can hire a bookkeeper, you can hire finance, you can hire, people in your investor relations department. And now instead of doing that one deal that year, now you're doing 10 of those deals. So now instead of making $1 million with your $1 million and being a one-man band and doing everything yourself, now you're doing 10 deals and you're making $8 million instead of building, just doing the one deal for $1 million. So that's really, syndication is a very powerful tool. And if you learn how to use it, you can really grow your company. So one thing we did to hire people and to keep, to kind of staff the company to run and be capable of handling these projects is we charge project management fees, asset management fees, and then we also take a little bit of the backside split when the property sells. So the fees up front are important. Because you need to be able to hire the people that are capable to do the job, and you want an operator or a sponsor that's focused on the job, not working at Starbucks on the weekends because they're not charging anything and they got to wait 5 years for profit, right? So you want to have somebody who's focused on a company and can dedicate their resources to it. And instead of investing our own money in deals, we continue to invest in and build the business. So that's hiring more people, that's finding more people. We sell assets and we have a promote. We take that money and we say, okay, what's the needs of the company from a staffing perspective? That's our number one expense right now is payroll. Our second largest expense is data. We spend a lot of money on data to track and make sure that we're buying the right projects. And then your investment thesis. We chose self-storage because it's recession resistant. During COVID, it did exceptionally well. It was deemed an essential business. We could still evict, we could still hold auctions, and people could still come and transact the property. And generally, we didn't have a very much delinquency, probably 2 to 4% across the portfolio. So when we looked at our investment thesis, when we started in storage in about 2016, as we said, we wanted something that was resistant to the economy. We also looked for the 3 E's: ease of eviction, ease of maintenance, and ease of operations. So we wanted something that, when you think about the 7,500 units or so that we have in our portfolio, I think we have about 20 toilets total. So when you think about maintenance and, a big apartment building, it's going to have, 2 bedrooms or 1 bathroom, or 2 bathrooms or 1 bathroom typically. It's a lot of maintenance. It's a lot of work. So if you're going to run a property management company, you're going to have to staff it quite a bit. And you're going to have a lot of variability in your capital expenditures. We also looked at the upside. We said, hey, this chart right here says, S&P 500 versus all other REITs versus the self-storage REITs. It did exceptionally well during boom times as well. And then we got busy building the brand, right? Building your brand, getting out there. We have a revamped website. We have quarterly newsletters we send to our investors. We're on podcasts all the time, monthly webinars to our investors, informing them on education, passive real estate investing. We have a really great Learn page on our website where we freely share information about syndications and kind of how they get put together. We're on social media every day. We post 5 days a week, project updates, new team members, just kind of general things that are going on at our company. Speaking engagements, masterminds have been critical. Meet with other people doing what you want to do or what you are doing in the space and share ideas. And then we do a lot of articles. We've been featured in, Inc., Forbes, ISS, which is the Inside Self-Storage magazine, and Self-Storage Association magazine. I always say it's easier to keep the investors that you have than go find new ones. So this slide is really important. If you're thinking about getting into syndications, the first thing you should do is think about your communication plan. So you spend all this time and effort convincing people to make an investment, and then you disappear. That's not good. That doesn't keep people coming back, and it kills off your referrals. So what we do is we have a very robust communication plan where we're communicating every month, every quarter. And we also do a quarterly conference call where we invite all of our investors in and we give them a kind of a high level update of the company and then go drill down into the specific portfolio. We also are extremely transparent in that we share all projects that we have going on in our portfolio on those calls to all of our investors. So if they were on it's kind of like an earnings call in a lot of ways, and it builds community among our investor group. So to wrap this up, we're going to go into the legal stuff, which I hope I don't lose you, because I'll try to make this as fun as I can. But if you raised money from your brother or your neighbor or your aunt or your uncle or your grandma, and grandma didn't expect to do anything in your project and they only expected to earn passive income, you sold a security to that person. And it doesn't matter who said what or where, you sold a security. So the security is selling something to somebody that's financial, that there's an expectation of a return and for them to not to do work. You do the work, they sit back, they give you the money, and off to the races you go. You just sold a security. And unlicensed people are not allowed to sell securities unless you file an exemption. And you can file an exemption to this under the Securities and Exchange Act of 1933. And this was something that's been around for a really long time. It's under Regulation D. And the most common exempted offering that's filed is 506B. There's trillions of dollars that are raised under 506B. These are private placements. And about 90% of all private solicitations are under 506B. So let's talk about this, because this is a very popular one. You've got to be a sophisticated investor. You can be accredited or you don't have to be accredited. And for anybody who doesn't know what accredited is, that's anybody who's got a net worth of $1 million, excluding your primary residence, or you make $200,000 to $300,000 if you file single or joint per year, and you reasonably expect to make that much in the upcoming year. But you don't have to be accredited to be a 506B investor. So let's just really get down to the details on this. When I graduated from college and started my career and then got into my first syndication, a lot of people who knew, liked, and trusted me were my college roommates, the people I went to school with. A lot of them went to law school. They had debt. They weren't accredited. So 506B made a lot of sense. I knew them. They wanted to invest, but they didn't meet that accreditation status. But a lot of offerings are done this way just because of the natural tendency to want to know people before you invest. So you have to have a pre-existing relationship, and you can't advertise. So you have to know the person first. You have to have some kind of substantive relationship before they can place capital with you. And the last thing is you got to do a purchaser qualification. So think of this as like hey, you need to give me a form that I give you, or fill out a form that I give you, 20 questions or so, that you tell me why you're sophisticated and can reasonably assess this offering. So it's a little bit of a gray area, but you have that record of the purchaser qualifications showing what the investor gave you to prove that they were sophisticated enough to do the offering. So let's talk about the most recent one. So the Jobs Act introduced 506C. 506C is where the industry is headed. And 506C is accredited investors only, meaning that you have to be accredited to invest. It's a black and white rule, and there's actually a third-party verification requirement for it, but it allows general solicitation. So if I had a deal and this was a pitch forum, I could go on and I could talk about a deal that I'm raising capital for. I'm generally soliciting the audience that I don't know, but if you come to try to invest, you have to be accredited. So, and I can't just say, oh, I'll take your word for it. You have to go through a third-party vendor typically, or your CPA or financial advisor, a licensed professional, has to certify that you are an accredited investor. And usually that CPA or financial advisor is familiar with your net worth and liquidity or your personal financial statement. And we use a service called Verify Investor, where our investors can go on and get certified on the internet. So they submit tax returns or liquidity or net worth or whatever it might be. And then we get a letter from an attorney saying that investor has been deemed accredited. So what documents do you need to do a solicitation? And I always encourage people, I'm not an attorney. I'm not your attorney. I'm not giving legal advice. I'm not a tax accountant. So do your own due diligence and just take this as friendly discussion. So, an operating agreement is usually required, an offering memorandum. This is your pitch deck. This is your 20 to 40 page bottom line up front, what what this offering looks like. It's your prospectus, right? So usually you have an offering memorandum that displays what you're trying to raise money for and how you expect to complete the business plan. I always say offering memorandum is kind of like your business plan as well, but it's a little salesy in that regard. The private placement memorandum, we're going to dive deep into this. That's your disclosure document. We'll talk about this more later. Purchaser questionnaire, that's again, if you're doing 506B. And then a subscription agreement basically says, you've read all the documents pertaining to the offering, and I'm subscribing this much money under this entity name. That's a subscription agreement. And then once all the funds are received and into the account, your attorney does something called, your SEC attorney, who's done a lot of these offerings, will file a Form D, and you'll do your blue sky filings. And I'll go a little bit deep in the blue sky filings for a second. So if a state of Washington investor invests $50,000 into your private placement, you have to advise the state of Washington, the Department of Financial Institutions, the DFI, that you've taken $50,000 from a Washington state-based investor. That's called a blue sky filing. And you have 14 days from funds receipt to actually make that filing. And that's what your SEC attorney does. So it's very important that you have a good attorney that's done private placements before, that you can hire to set up your offering docs. So let's go into the private placement. This is my favorite document. If you gave a new investor this document, it would scare them into not investing, but that's what I like. I like to see the risks, and I like to see the devil in the details. So there's three main things in the PPM. Risk factors. This is how you can lose your money. So the risk factors disclose all of the risks associated with the project. So this first paragraph, I won't read it, but it basically says, if we can't get an expansion approved, which relies on city officials, then that could alter your returns. The second paragraph says, if there's a reassessment of the property, our property taxes could go up, and that could hurt your returns, right? And the last paragraph on the bottom is a great one. That's a COVID disclosure, basically saying we're in the middle of a pandemic, and if something happens, that could impact your returns, right? So the risk disclosures are very important. And usually when I get an offering from somebody, I don't really, the offering memorandum is great and that gets me excited, but I want to go into the PPM and start reading the risks. I want to know what the operator has thought about as risks. If there's not very many risks, then I don't know, maybe the deal is safe, or maybe the operator hasn't really thought about what could go wrong. The other thing in the PPM you want to look for is project fees. So this is a fee schedule that tells you every way that operator could make money. So in this instance, we have sponsorship fees at the top, and we specifically list how we charge those fees, and any third-party servicing fee that we have against the property is listed in there. So this is your disclosure to your investors saying, this is how I'm going to make money on this deal. Waterfall. The waterfall is very important. It's who gets paid and when. That's outlined in the private placement memorandum. So again, I won't go through this in detail. This slide deck will be available on the CCIM page, and it's available for sharing. But this is how you get paid. So this is, if you have an operating facility and there's net distributable cash from operations, how does that get distributed out to your investors? And if you sell something in the deal, if you sell the asset or you refinance the asset, that's called a liquidity event. How does the money get chopped up if you have a liquidity event? So very important stuff. So let's talk about the last deal real quick in a real live example of a liquidity event. So we had a sale of the car wash. We just sold it for about $1 million. And, there was some expenses, but let's just say for this example, there was about $1 million of proceeds from that car wash. We're not paying back all the money, but we've got this cash event that happened at the property that's fairly significant. So we had $2.3 million of private equity that was raised for that project. And our waterfall says that in the event of a liquidity event, the investors get paid back their capital contribution balance first, pro rata based on their ownership. So in this instance, we sent back 40% of their equity. So in this case, 2.3, we sent them $1 million chopped up pro rata. And now their new pref account is based on 1.3 in equity. So we do a pref and a split. So now when we send out the distribution waterfall, it's based on $1.3 million of equity and no longer 2.3. So that's just an example. What if we did a refinance and you had $1 million in a refinance event? That $1 million would get allocated based on the waterfall. So if you're doing a deal, I always say, look at the private placement memorandum and understand how every dollar flows through and gets chopped up. And then the next slide. So just kind of in summary, if you're getting into syndication, focus on building your brand and you're building your business. Make your offering slide deck, make your portfolio projects, get out there and talk to investors, provide value first. A lot of people, are in the, if they're into self-storage or multifamily, that's great. But I always like to say, getting a general understanding of the entire real estate industry kind of makes you a real estate knowledgeable person that people come to for real estate related questions. That builds trust. Be ready for massive follow-up. If you have people inquiring to invest with you or filling out your web intake, make sure you actually have a process to follow up with that person. Don't let leads go unnoticed, especially referrals. Keep it simple in your offerings and make sure you do your filings and your corporate documents. It's really important. You can't just not do your blue sky Form D and your reporting that's required under the exemption that allows you to raise capital in the first place. And your action plan. I always like to say, I'm just thinking about getting into this. What would be the first thing that I do? Well, first thing I would do is I'd identify your team, and that involves a syndication attorney. I'd get a syndication attorney together. If you're thinking about raising capital, I would have a consultation with an SEC attorney or somebody who does private placements. Build your marketing plan and materials. Start building your list. Reach out to 10 people who you might think might be interested in just being on your list, and start providing them value with a newsletter or what you're up to in the space. Start your newsletter, network with 5 new investors a week. We usually have about 5 to 7 calls a day with investors. Join a leads group, or that's just networking or marketing. Places like CCIM or meetup.com, are full of places to go and network. And then continue your education. I learned how to syndicate at the Secrets of Successful Syndication seminar put on by the real estate guys, and they do a great job of kind of spending a couple of days and giving you the basics on syndication. But there's many other resources out there, to include CCIM, to continue your education, so you're continuing to sharpen that axe and you get smarter about your company and your syndication business in general. So with that, got some time for questions.
Thanks, Ryan. I have one question. So a lot of our audience today are brokers, and let's say that they have some a raw land project that they've listed, or self-storage, or an apartment building, and someone comes up and makes an offer that is they're going to fund the project through syndication. Do you have any recommendation on how they could vet that potential buyer?
Yeah, a couple different ways. I would ask for portfolio projects. How much money have they raised in the past, and them as an individual. And if you want to check that, you can actually go to a website called formsd.com. And that's every single private placement that's ever happened. So if you go to formsd.com and you look on that today, you can see all the solicitations that have been filed. Put that person's name in the Forms D website and see if it populates, and kind of fact check that person has actually raised capital and capable. And then I would ask for their contract to close ratio. How many contracts have they not closed that they put under contract? That might be a little bit of telling. And if they have a poor contract to close ratio, ask them why, and kind of get their game plan for, how they're intending, and see what their process is. Maybe look at their website, and see, how much capital they've raised, their network of investors, or, what kind of investor presence there is on there. And just look at their track record. It's probably the biggest thing.
Okay, thank you.
Yeah, you're welcome.
And also, so you've had great success with building a business and having a lot of capital. Or is there plans to not use syndication in the future? Are you going to be finished?
Yeah, it's a great question. So, and we get it all the time. And the answer is absolutely not. So no matter how much, no matter how successful the business is, we're always going to have investors. And the reason why is that example I gave a little bit earlier, which is, if you can raise capital from other folks and keep, investing in your company and building your company and its capabilities out, you can really scale and grow. And, the extreme example is like a company like Amazon still has investors, right? Because that capital is more efficient than, some of the capital it generates to put back into its business. So, having private syndication is a great way to lever your business. It's no different than a bank. Having a bank loan to leverage your business is a great way to scale. And a lot of people use loans because it makes your project more efficient. Your returns get better.
Okay. We have a question from the audience. What advice would you give yourself when you started in 2013 to get you where you are today?
Yeah. So first of all, I would say, why am I doing this? Am I trying to just replace income with my W-2, or am I trying to do 5 deals a year, or am I trying to build a company? Right there, there's lots of different ways, but I would first kind of check in with yourself and say, what do I want to do with this thing? Because for me, I would tell myself, hey, you need to read, these books, all the books that I've read over the last, few years, the book Scaling Up, How to Win Funds, go to conferences like How to Win Funds, Influence People, go to the Secrets of Successful Syndication conference, learn about syndication, and then focus on, building business books, not necessarily real estate, but, how to hire the right people, how to come up with the right strategic plan. And because that can help you grow a company, not be so much of a deal chaser, but a company builder. But if you're looking at just doing a few deals a year, your needs, wants, and desires, might change a little bit. But in any case, I would make a strategic plan, and I would map out, and it's as simple as, what do you want to do? What are your goals for the next 3 years as you or as your company? Because it'll help shine light on questions that your investors might have. Our first investor actually invested because, a significant amount, because they were like, okay, we know Ryan and Scott, but we know what they're doing, but I just can't see the vision of what they're ultimately after. And when we showed them our strategic plan, they were like, wow, these guys have thought about where they want to go and what they want to do. And this isn't just like a side hustle they have today that they're going to be doing something different tomorrow. They've kind of given this some thought. So, I would have a plan. It doesn't matter what your plan is, and I would write it down and stick with it.
Okay. And one more question. We have, why not use a fund instead of syndication per project? Yeah,
so a fund that's a great question. And we have used fund to funds, very close personal relationships. It's not as, I'll just be blunt. It's not as enjoyable. Our investors know us, a lot of personal relationships. We have about 35 employees, and I think there's probably 10 parents in deals. And it's a lot more, the why is there, and the capability of trust is there. When you bring in fund or institutional money, yeah, it's abundant, but they're coming for blood, and they don't care. They are usually fiduciaries of, the money that they're raising, and it's incredibly more stringent, and not as enjoyable. We want to enjoy what we do. We want to enhance the lives of our investors. And sometimes funds just aren't as interested in that. We have a little bit more of a personal approach to, we want to know each investor. We don't want this just to be this huge thing that we don't know anybody. And when we make one little mistake, it says on this line, we want to do the right thing, over having, so much just kind of a cold relationship with funds. So we've been able to really scale a business that way. And it's just a lot more enjoyable.
Okay. One more. Someone wants to know if they should be bonded if they're going to be a syndicator.
Yeah. So we have a handful of insurances. Cyber is a big one. And talk to an insurance broker. I'm not an insurance attorney, so obviously, your needs are different than my needs. This is just some friendly discussion. So we have cyber insurance. We have key man insurance. So if one of us gets taken out, there's a key man policy there to replace me. So, they can go hire, they'll have the funds immediately put in their account on a key man policy if I were to pass away, to go hire my replacement. And our co-founders are both key man. We also have directors and officers insurance. and we have an E&O policy. So if this something happens, we've got that extra protection. I know that there's a bunch of other insurances, but as anybody knows, the first line of defense in any part of litigation is insurance. So it's really important to make sure you've got the appropriate amount of insurance for what you're doing.
All right. Well, we've reached the end of our hour. Kelly, did you want to wrap anything up, or can we go a few more minutes? Or is
Well,
it?
I think we've reached our time. Thank you so much, Ryan, for all of your information. It was fabulous. I think we all know a little more about how to grow our own real estate portfolio. Steve, thank you for moderating, and attendees, thank you for joining us today. I hope you've learned more about syndication. This recording will be on our website, CCIM-WA.com. By the end of the week. And I also want to thank our sponsors for sponsoring CCIM Washington State. We strive to bring the best education to commercial real estate. Get involved with us, join us, whether it's membership, sponsorship, or committee involvement, or networking. Check out our consultation clinics, and all of that information can be found on our website, CCIM-WA.com. Please attend our next seminar, which will be April 14th, Wednesday at noon, which is an economic update with Ted Jones, the chief economist at Stewart Title. So that will be very interesting to see where we go from here. All right, everyone. Thank you so much and have a great day, okay? Take care.
Thanks, everybody.
Thanks, everyone.